Right, we'll make a start then. And firstly, good afternoon and welcome to our very first AIM listed Future Ready webinar hosted by Cooper Parry. Thank you very much for joining today. I'm grateful that you've been able to make the time to join us. We've got some interesting and engaging topics for you today. If nothing else, you'll get an hour's worth of CPD credit and we'll send you confirmation after the event has finished. If you have questions as you go along, comments or thoughts, please use the chat function or the little Q&A button you should be able to find at the bottom. We'd love to hear from you. The agenda today is as follows. So you've got 3 speakers talking to you today, myself, some audit and reporting updates. We'll move on to sustainability with Laura, and then Tom will close out with some tax reminders. We're going to save 10 minutes at the end for those questions, so please do participate and let us know what you would like to hear more about. So I'll kick off. My name is Justine Hughes. I'm an audit partner at Cooper Parry. I work in our big business team. I started my career at KPMG. I was there for nearly 11 years before moving to Next to work in their group finance team. I decided audit was a place for me, so after my maternity leave, came back to join Cooper Parry. I've worked with listed businesses my whole career, and the reason I'm now really focused on AIM listed clients for the majority of my portfolio is that it's a really exciting combination of that discipline of listed reporting, the technical challenge you get with some of the accounting concepts you're using, as well as this entrepreneurial spirit. They're on a growth journey, and it's exciting to see that trajectory take off. So what am I going to talk to you about today? 3 topics that I would like to cover. So Notice 62, if you've not seen it, I'm going to tell you what it is and what is that going to mean for you and your business. IFRS 18, when does this land? What impact is it going to have, and what action can you take today, most importantly? Finally, Provision 29. Now, for any of you that have seen Provision 29 or know what I'm talking about here, you will realise that this isn't mandatory for AIM listed businesses. So why am I talking about it? I will give you the answer to that question when we get through. First topic then, Notice 62. What is this? So the London Stock Exchange has published AIM Notice 62. It's a 12-page document as part of its Shaping the Future of AIM project. So we're in the consultation phase at the moment. It isn't quite reality, but I'm really hopeful that this is going to translate into some final rule changes. It's extremely exciting if you're into the world of AIM. The London Stock Exchange have been listening to the noise that we're all hearing about how burdensome AIM can be, about it being fairly inflexible and ultimately quite costly and unattractive, particularly for new entrants, but also for people currently listed. You will have all seen the headlines around how many people are leaving AIM and have done. This notice, this consultation, is giving us a really clear indication of where regulation is heading. There is going to be less of it, less regulatory burden, greater flexibility, faster access to capital, and a better and stronger reliance on management, boards, and nomads, the people that really know these businesses and the trajectory, that growth journey that they're on and what they need. So this big question here, will this make AIM easier, cheaper, and more flexible for my company? The answer is definitely yes. So the consultation here repeatedly emphasises that AIM is a growth market. It is not a mini main market. There are lots of changes aimed at making it more attractive to people coming in, which of course will have a benefit for the people already listed in terms of making it more buoyant and more interesting for investors. But what should you care about as an AIM leader sitting listed already today? I've pulled out a couple of things I think are relevant, but there's lots in there. So if you've got some time, have a quick look. The first thing I'd like to talk about, flexible reporting. So the most immediately relevant financial topic for any of you sat in that seat is a potential move to FRS 102. So this proposal would allow AIM companies to choose FRS 102 or IFRS. The rationale being that the conversion cost, particularly for a new entrant, can be costly and can be complex, particularly for smaller, high growth businesses. What does this mean for you as a CFO that has had to go through that change and does sit under IFRS? Well, it isn't an everyone should switch, of course. The question that you need to ask yourself is, if this change comes through, what value are you getting from IFRS? Is there any? And could you change and make your life simpler? For lots of you, IFRS is useful. Your debt facilities might require it. Investors are familiar with it. Your international shareholders and structure might mean that they are more used to it and they need to see it in that format. But for some businesses that are UK focused, this could create lower reporting costs, simpler reporting processes, shorter accounts, fewer technical complexities, and hopefully reduced advisory spend. The next one, larger transaction threshold. This is probably the most commercially significant. Most AIM companies aren't going to switch their accounting framework. Most of you aren't new entrants, of course, but lots of you do acquisitions or would like to. So under the current rules, a transaction is substantial if it is 10% or more of the AIM class tests. So 10% of more certain metrics like gross assets, profit, turnover. What this is going to do is shift the dial on that upwards to 25%. The reason being that most transactions between 10 and 25% are not transformational. They are material, but they are not going to change completely the direction of travel of your business. They're usually bolt-on acquisitions. What the LSE are saying is they are listening. So why are you imposing all of this additional regulatory burden for people that are high growth? It comes back to this theme of the consultation. They want to make it easier for businesses that are entrepreneurial, that are trying to pursue this kind of buy and build strategy. Next point, capital access window. So this hasn't received loads of attention that I can see so far out and about, but I do think it is interesting. So in simple terms, the exchange is looking at ways to make equity fundraising easier. So they will allow you to suspend trading while a raise is being executed. The detail of this will evolve, I'm sure, but the key message here is that they recognise access to capital is hugely important for, again, this growth narrative that they're trying to help the AIM market become better at. And they're trying to reduce friction and reduce volatility in that period where you are raising capital. So key takeaways. If IFRS is not valuable, you could choose FRS 102. Deals that are material, but are not transformational could become much easier to execute. And raising capital could be less friction and less volatility. These are really good, interesting, exciting, fairly big changes. But my biggest takeaway is probably that the LSE is listening. They know that AIM is a difficult place to be listed and they are trying to do something about it. Some really useful, practical changes. As finance leaders, it is a time for you to challenge whether any of these things are causing you problems, whether you are not doing transactions because of the cost, whether actually FRS 102 might be useful. So have a think about it and be prepared for hopefully when those changes come. Next topic for me, IFRS 18. So this isn't in consultation phase. This is real and it is coming soon. So it is mandatory for periods beginning on or after 1st of Jan 27. So for lots of you, you are already in your comparative period. So what is it? This is replacing IAS 1. So it isn't about how your P&L is presented. This is about how your P&L is presented. It does not change your profit figure. It's not a recognition and measurement change. It is simply the way it is organised and the way that people will view it. What this is going to do is apply a cash flow mindset to your P&L. And that is the simplest way to think about it. So why are they doing this? Comparison. So what they want to do is make it much easier for investors and users of accounts to look at two different sets of IFRS listed accounts and be able to see the P&L and look at them side by side. You might not feel like you do, but at the moment under IAS 1, there's quite a lot of flexibility about what ends up in your operating profit and doesn't. And they're trying to make that less different across businesses. As I said, the way to think about this is applying your cash flow mindset to your P&L. So you will recognize these buckets: operating, investing, financing in particular from your cash flow. Tax and discontinued operations, of course, come at the end. These buckets are supposed to split your business into the core business under operating, your returns from your investments and associates, and then the cost of funding the business. As I said, this isn't a recognition and measurement change. What it is doing is just reorganizing where some of the items of cost and income need to be on the face of your income statement. So the biggest practical change that will happen is that you probably need to remap some of those things. There are two new mandatory subtotals. Some of you will be showing these already, of course, but what goes into them might end up needing to be slightly different. Operating profit or loss and profit or loss before financing and income tax. So this removes some flexibility that you have at the moment. And for entities using the indirect method for your cash flow, so this mandatory operating profit item is now the required start point for your cash flow statement. Two other things that are worth noting. Management defined performance measures, MPMs, as they're going to be called in shorthand, will move into being audited numbers. So what this means is that performance measures that you use that are outside of the usual statutory ones, the most common being adjusted EBITDA in some format, they have to be defined in the financial statements. They have to be reconciled to the nearest IFRS number. And what you will need to do is have them in a note, a disclosure in your accounts that is audited and it is shown in a particular format. Lots of you, what does this mean? Probably not a lot of change. It will feel very similar. Your auditors should be looking at these numbers. Most of the add backs that you put in there will be looked at anyway. Things like depreciation, interest, of course, will already be audited. So I don't think this will change too much how it feels, but it will need to be disclosed in a particular way. This is a comparability warning. So it's just making sure that it's easy for people using your accounts to see how they are put together. And detailed breakdowns need to be included of the methodology that you're using to get to those numbers. Finally, comparatives must be restated. As I said, you are in your comparative period, most likely or very shortly. So you do need to be thinking about this today. Which teases us along nicely to action for today. Think about remapping your costs and income into the new categories. IFRS 18 is published, you can see it. So go and have a look at what needs to go where and start thinking about how much work that might be to just put things in the right place. Management accounts. They may currently reflect IAS 1 or the certain types of profit measures that you like to use. It is worth thinking about whether you need to make any changes to those management accounts, whether you want to, whether that will make it easier for your board members to move between management information and then ultimately the annual report that they will see at the end of the year. Be prepared for audit challenge. We will be asking you questions about this. We will want to know how you've decided things go between the different categories. It's fairly prescriptive and it's definitely one you can get ahead of already. So do speak to me or whoever your auditor is and ask for some advice on what your disclosures need to look like. We can have a look at that with you and get ahead of it before it gets all a bit tight towards the end when you're publishing your annual report next year. It is worth thinking about your interims, of course, which will be coming more quickly and whether you need to make changes before you get there. The biggest risk here is messaging risk, right? So it's not technically complex. You're not going to have to go away and do loads of mad calculations that are going to be difficult and tricky to understand. It's just about explaining to the users of your accounts why things will suddenly look different to what they perhaps did in the prior year. Provision 29, this last mystery topic then, is not mandatory for AIM companies. So why am I talking about it? So Provision 29 of the UK Corporate Governance Code applies to main market companies and has done since the 1st of Jan 2026. So this requires a board declaration on the effectiveness of material internal controls. Why should AIM finance leads care? So you're not mandated to comply, but investors are increasingly expecting clear statements around controls. Auditors are focused on financial controls and having a look at these with you and what impact they're having or not having on the business. And you'd be, well, maybe not amazed, but I get lots and lots of questions now from my AIM listed audit committees about what work we've done on controls, about what our opinion is on the controls in the business and how well they're being looked after. So again, similar to Notice 62, I suppose the thread here is a direction of travel. It's a narrative that's coming for businesses in general, but particularly listed ones, that controls are important and boards should understand what your key financial controls are. So finance teams, therefore, need to be able to articulate what controls exist, where weaknesses are potentially, and what is being done about them. Another good reason to know what your controls are is the ECCTA. So if you have seen this, hopefully the Economic Crime and Corporate Transparency Act is now in place. So this impacts large organisations, whether they're listed or not. So again, might not be relevant for some of you, but it does introduce a new criminal offence of failure to prevent fraud. So what this means is that controls are now a legal defence and not just good governance. So organisations can be liable if fraud is committed by someone on behalf of the organisation or for the organisation's benefit, I should say, unless you can demonstrate that reasonable fraud prevention measures were in place. Your controls are important. They're not just good governance, as I said. So if you don't have well-evidenced controls, this can expose you to prosecutions, fines, reputational damage. Might not be legally relevant for some of you if you're not a large organisation and if you're clearly not main market listed. But again, as I said, it's a direction of travel, and it is, of course, good practice to just make sure you're on top of some of these things. Key learnings for me then. Notice 62 could make AIM easier, more flexible and cheaper. Give it some attention. I will, of course, give you any updates as soon as I see them. IFRS 18 is definitely happening. That one is real. It's mandatory for December 27 year ends onwards. You are in your comparative phase now, and it will change the organisation of the face of your P&L. So look to get on top of that soon. Provision 29, not mandatory, but is a good nudge or control. So give that some thought. I'm going to hand you over now to Laura.
Hi everyone, I'm Laura. I'm a director here in our projects team, and I head up our ESG service offering. So I'm just going to talk to you today about ESG, where we are now, where we're going, and how to future-proof. So if we can go on to the next slide. So in the world at the moment, obviously there's a lot going on. We're having a lot of conversations with clients who are in the process of passing on increased transport costs and things that they could never have seen coming. I don't think I could spell Strait-of Hormuz 12 months ago, but we are where we are now today. And I think the main thing I want to pull out from this slide is that the renewable energy now, in the majority of cases, is getting a lot cheaper than fossil fuels. And fossil fuels are going up, being more volatile, and just a lot less predictable. So actually, whereas before, I think a lot of conversations we were having in an ESG space over previous years was reporting burden, nice to have, doing more than you need to. It's now you need to understand where your emissions are, because you need to understand how to reduce them, because there is an impact to your bottom line and your profit. So real world impacts to your business of this. As far as reporting, so currently anyone sat here with an AIM listing and 500 employees will be familiar with NFSIS, Non-Financial Sustainability Information Statement. We love an acronym in ESG, as you will learn. So this is mandated in the UK. It's Companies Act requirement. Where you have been previously reporting your emissions, that's obviously your company's impact on the climate, whereas this is a statement that is based on the climate's impact on you as a business. So there is an acknowledgement that climate change is a risk to all companies now. So actually you need to talk to how that's going to affect you as a business and your ability to still be here in 10, 20, 30 years time. So it's investor focused. So it's you talking to your investors about the risks and opportunities of climate change. So I think when we review these statements, often when they first come from clients, they will be heavily risk focused because it's kind of easier and you can kind of talk to that. Whereas actually what you want to tell your investors is the opportunities as well. So if you are producing diesel cars, clearly that is a risk. Climate change, customer preferences are going to change. You've got some risks coming. But actually, are you developing the newest electric car that goes faster than any other car? That's a massive opportunity for you. So making sure, bringing through both, and then also wrapped around that, the strategy that you're taking as a business and the governance to ensure that you are mitigating those risks and maximising those opportunities. Threshold for parent entities, I just wanted to touch on, is another one where we see that clients potentially miss this. So as I say, if you've got an AIM listing and 500 employees, you're in scope. That definition of 500 employees is global operations. So underneath the UK company, have you got 500 employees globally, not just in the UK and not just who you are consolidating? So if you do not consolidate in the UK, you might never see that 500 number because it's never in a set of financial statements that you're looking at. But actually, you've got a French subsidiary with 600 employees underneath. You are caught by this and need to be doing this disclosure. We just wanted to share that link as well from the FRC. They did a thematic review of the reporting. So it's been out 3 years now. They did a review of the first year reporting. Some really good examples in there of good reporting, bad reporting, downright non-compliant reporting, but also just to flag it is on their radar. They are reviewing it. We are having clients get letters from the FRC where the reporting is not up to scratch. So as I say, have a think, have a read around, but that's kind of the main and the newer one. And then if we go on to the next slide, I'm just going to touch on SECR, so Streamlined Energy Carbon Reporting. This has been around for a bit longer, so I assume more of you will have done it or seen it. Those are the thresholds, and as Justine touched on earlier, the large company thresholds are looking slightly different now. They have increased, but for SECR, they are not. They have stayed put. There's a few elements of SECR that I think we're expecting some updates to guidance or a bit more clarity, but as you'll see, there is new stuff coming, and I think it's going to supersede this and this will all go away, so it's just not a priority. So we're working with what we've got. So obviously under this, you are putting out your Scope 1, Scope 2 and business travel by road. UK focused again, Companies Act, UK emissions only, doesn't matter what you're doing anywhere else. This is a UK problem. And then what are you doing to reduce those? An intensity metric as well, which kind of will give you the credit if your emissions going up, but you're growing as a business. It's making sure that that is reflective. As far as exemptions, obviously you've got low energy user, and then there's also exemptions around a group structure. So if you are caught because your group consolidated numbers are above those thresholds, you can actually exclude any subsidiaries that are individually below those thresholds. So I worked with a client recently who had been doing full group reporting, but actually each of the subsidiaries could be excluded, and all you were left with was the top co who worked in a tiny little office and was actually a low energy user. So didn't actually need to be doing any of it. Not that I'm encouraging anyone to stop looking at their emissions data, but obviously make sure you're understanding what exactly you have to do if you're in the capacity of doing what's mandated. If you've got, the team are under the cosh and you're just trying to get through, make sure you're not doing more than you need to if that's the case. And then on the next one, please. So what is coming is ISSB S1 and S2. The standards have been released. They have been finalised for the UK context. Very few changes for the UK to the main ones. They are available for voluntary adoption if you so wish. They are going next year into premium listed, so FTSE will be doing them next year, and then they will be rolled out. So this is what is going to happen in the UK. We are going to be doing it, but we just don't know at what pace. So as with the NFSIS reporting, we'll see it go into premium listed, and then it will roll down into large company and down and down. If we go anything like the rest of the world, so it's gone into a lot of countries now, but Australia, for an example, has taken it all the way down to a 20 million turnover threshold. So pretty low, and mandatory assurance. So this is kind of the direction of travel. Anyone that's doing business with Europe will be fully aware that they have gone whole hog, a lot of reporting, a lot of assurance. So your SECR numbers that you've been putting out previously is other information in your financial statements at the moment. So your audit team are not required to look at that. They have to check it for material inconsistencies. Whereas once we're getting into mandatory assurance within the ESG space, finding a lot of problems. Obviously, it's not as mature. You don't have the controls. You don't have the data processes around the emissions data or anything else that you've been getting ready for hundreds of years in the accounting space. So it's a big battle, and there's a lot to come. But if you're doing NFSAS and SECR, there's layers to go on top of it, but it's hopefully not too big of a leap. If you've not been doing those things before, hopefully you'll remain out of scope for a good few years yet, and it's not an immediate problem. The only other thing I was going to flag on this is that if you have got any FTSE businesses in your value chain anywhere, your scope 1 and 2 emissions are their scope 3 emissions. So you may be getting more and more requests for primary data, emissions data. We're seeing more and more clients are, if they're going for a tender with any big software companies or all sorts of random scenarios, NHS as well, we're finding emissions data is required in those tender processes. And we have actually seen examples now of legal action being brought because you've won a tender with incorrect information in it if your emissions are wrong. So that is starting to happen. So if we go on to the next slide. So obviously there is a lot you can do. I think most of my conversations with clients are around, I've heard about this thing, I've heard about that thing, someone's tried to sell me this, what about this? Lot of things you can do, a lot of ways in which you can go. But as far as future proofing, and if I was sat in your seat right now, I personally would be focusing on data. So things like net zero plans, lovely to have, but how on earth do you start a net zero plan if you're not absolutely sure about what your emissions are and where they're sat? So if you just pop on to the next slide. So final thing from me, again, if I was in your seat, what would I be doing? I would want to be extremely confident with my scope 1 and 2, potentially even getting starting to get someone to assure those, have a look at that, and working out where scope 3 is going to go for me. There is 15 categories of scope 3. So what does that look like for your business? And also, who owns this data? So scope 3, 15 categories, big exercise. Have we previously just defaulted to, well, we're only doing SECR, that sits in the financial statements, so it's a finance team problem? Or actually, is there somewhere else in the business that's better suited to produce this? Or actually, do you need to get someone in? Do you need an external provider? Who's going to oversee this as it starts to escalate? And then the other side of the data is the scenario analysis. So if you've been doing that NFSAS, you'll hopefully be familiar, basically saying under a 1.5 degree scenario or a 2 degree scenario, or whichever scenarios you choose, what does this look like for us? Back to that investor focused risks, opportunities. In a 2 degree scenario, actually the factory that makes 90% of our product is going to be flooding 3 times a year. So actually, how does that pan out for us? What do we need to be doing? Do we need to be diversifying our supply chains, etc., etc.? And if you are doing scenario analysis already, the main shift that will come with ISSB is we're going from what are the risks to how much are these risks going to cost me? So that's the big jump, is going full scope 3 and then cost implication numbers. What revenue am I going to lose? So again, in the diesel car scenario, no one buys diesel cars anymore. What number are you going to wipe out? What capital expenditure you're going to have to do to start building electric cars? So the shift with ISSB is going to be that, as I say, it's SECR plus Scope 3, plus more governance chat, plus more strategy, and then that putting some numbers on those risks and opportunities. So that's it from me. I will hand over to Tom to talk to you about tax.
Thank you, Laura. Good afternoon, everybody. Thank you all for joining. So my name is Tom. I'm a senior manager in the business tax team. I've been with Cooper Parry for just over 2 years at this point. Prior to that was Big Four. My kind of background experience is with large corporates, multinationals, international tax, that kind of thing. So I'm going to spend the next 15, 20 minutes or so just running through a few tax reminders for AIM listed and growing businesses. Now, the objective and aim here is I'm hopeful that you should have a bit more insight into where certain tax risks sit within your business, and also be able to start taking steps to improve the position as well where needed. Now, tax is obviously a huge area. So you'll see on screen, I've grouped these into 5 themes. So we've got international risk, compliance and share options, governance, debt, and finally, the slightly more interesting title, skeletons in the closet. Now, there's a common question which is running through all 5 of these, and that is, if tax due diligence started tomorrow, what would be found and would the business be ready for it? So let's start with international. So we've got 4 kind of separate categories here. And what people often don't expect is that international tax risk often starts with like perfectly normal commercial activity. So, for example, you may recruit somebody overseas, you may allow a UK executive to work internationally, or you may use a local agent or start negotiating contracts abroad. The commercial activity generally moves quite quickly, but what we see as tax advisors quite commonly is that the tax analysis doesn't always keep up, which consequently could leave your business exposed. And the first question is whether that any activity creates a taxable presence or a permanent establishment. And what I would make clear here is that you don't necessarily need an overseas company or a formal office to create a PE. So it can just be an employee, an agent, a project team, and all of those can create corporation tax, payroll, social security, VAT, other filing obligations. And what I would say is quite closely linked is tax residency as well. And that's not simply where the company was incorporated. It's quite important to consider where key decisions are actually being made. So board minutes, governance documents need to match the reality. So, for example, you may have an overseas entity that could be classified as a UK tax resident if it is centrally managed and controlled from the UK. So just keep that in mind. And then moving on to these final 2 points, so we've got cash repatriation. The key risk or key kind of point to flag here, dividends, interest, royalties, sometimes also service payments as well. They may attract withholding tax. So treaty relief can often help, but what is important to flag is paperwork usually needs to be considered before payment. And we do see from time to time where we've got loans from an overseas intermediate parent entity, for example, and no withholding tax clearances in place. And consequently, because you've got interest going cross border, you may have a withholding tax obligation there. And then just to close on this bit, so we've got transfer pricing, and the key questions I would be thinking about here are my intercompany service agreements, are my loans, are my management charges, are they all documented? And do these agreements reflect the commercial reality? Is that what actually happens? if you've got any loss-making subsidiaries, for example, an overseas subsidiary which could be loss-making, could you explain to the tax authority why that's the case if you were put on the spot? So those kind of questions I'd be thinking about from a TP's perspective. But the overall kind of conclusion here is, does the group's tax footprint, does that match its commercial footprint? We want to match the economic benefit to where you've got your substance, your assets, and where you bear risks. And the final bit on transfer pricing is just an update, just to make you aware that we have had UK reforms to transfer pricing in the permanent establishment legislation. So these changes apply for accounting periods starting on or after 1 January 2026. Now, the key 2 points here is potential exemption for UK to UK transfer pricing adjustments where there is no anti-avoidance or tax advantage that's being obtained. And then consequently, there was also some changes to the permanent establishment definition just to align it more closely to the OECD. So we'll move on to the next slide where we will look at share options. So quite a important aspect for employees. It can be a very valuable recruitment and retention tool. And we've got two categories really. So you've got your EMI and your CSOP, which you'll see on the left. Now they are what we call discretionary arrangements. So you can pick and choose who will partake in those schemes. And then you've got a SIP and a SAY on the right-hand side, which are all employee arrangements. So a SAY is an option linked to employee savings, whereas a SIP allows employees to acquire or receive shares. Usually in trusts, you get like bonus shares potentially as well. And I guess the right scheme really depends on your objective. So are you looking to retain a few key executives, in which case you might be looking at EMIs or CSOPs, or are you encouraging wider ownership within the employee base, in which case you might be considering your SIPs. So it all depends. And what I will flag is it's also an area where relatively small errors can have significant consequences. So you'll see in the box in the blue that I've outlined a few different points that are worth considering, because oftentimes there may be what you think is a tax advantaged scheme, an EMI or a CSOP, but for some reason the documentation doesn't align or the valuations are unsupported, amongst all those other kind of areas noted there. And what that can actually do is result in it being a unauthorized share scheme, in which case you potentially lose some or all of the tax advantages on that front. And then just a final reminder on share options was the ERS deadline, so 6th of July 2026. So make sure you filed, just make sure you've got complete and accurate returns, including any nil returns as well. Where I would land overall is if something has been missed, it's much better to find it now than in a transactional, when in a data room when you're going through a transaction, and also just consider your share schemes carefully. So I'll move on to just a overview in terms of compliance. So a lot of noise here. So you've got your annual recurring items. Now I've just thrown on screen a few items that are fairly common. So you've got your CT returns, ERS, overseas filings, and very quickly becomes a very large list. And then in green at the bottom, you've got what I'd say is hopefully non-recurring issues, especially on the kind of open inquiries point, but other compliance considerations. So ensuring that you've got your intercompany agreements prepared, and they could potentially stand up to challenge. Ensuring that you've got any withholding tax clearances in place where needed, and then being aware of your open tax inquiries, so what the issue is, the exposure, who owns it, the deadline, and any potential accounting or transaction impact. So I'm kind of thinking there uncertain tax positions, potentially contingent liabilities and contingent assets, depending on your estimation uncertainty. So we'll touch on tax governance next. So quite a lot here. So what's quite important to flag is that tax risk it shouldn't sit solely within tax and finance. There's not all of these formal requirements will apply to every AIM business. So particularly SAO, for example, or published tax strategies and uncertain tax treatments. Those notifications all depend on relevant thresholds. But the underlying principles, I guess, apply much more widely. So if we just start with businesses within SAO, the requirement is not simply to submit a certificate. So the senior accounting officer must take reasonable steps as well to ensure that appropriate tax accounting arrangements are established, maintained, and monitored as well. And then similarly, a published tax strategy as well shouldn't just be last year's document. You shouldn't just roll it forward. It needs to have more than just the date change, basically, and it needs to be updated to more accurately reflect how the business manages tax risk and deals with HMRC. And then the next one is quite interesting, the CCO and Criminal Finance Act. So this has been in place for a little while now, but a business can be criminally liable where an associated person criminally facilitates tax evasion, and the business, and this is the key bit, the business didn't have reasonable prevention procedures, so your internal controls, and that associated person could be an employee, contractor. It's much wider than the finance team. And the reason I mention and a bit more of a stress on this, even though it's been in place for a little while now, is that there has been the first prosecution now within CCO. So August 2025, a firm within Stockport has been prosecuted. Now at this point they have not been charged, but what that kind of shows is that HMRC is now willing to use the legislation to try and tackle potential anti-avoidance. So even more reason to have controls that prevent tax evasion and tax avoidance as well. So policies alone aren't enough. You need evidence. You need to evidence the risk assessment, carry out appropriate DD training, and ensure that the controls are monitored as well. So we'll go to look at debt considerations next. So 3 main points for debt. So debt is an area where commercial accounting and tax positions don't always align. So the starting point is simple. The interest in the accounts does not automatically mean that there's a tax deduction, and there's so many hoops that you kind of need to jump through when considering deductibility of interest and related costs. So the first kind of point we'd be thinking about here is the debt commercial and correctly priced? So we're thinking about transfer pricing, we're thinking about thin capitalisation, and we're thinking about unallowable purpose and the purpose or use of the funds as well. And the question you probably want to ask, just to kind of have an idea as to whether you've potentially got a tax issue, is would this borrowing exist in this amount and on these terms between independent parties? And can we evidence why it was needed? So we're thinking about amount, we're thinking about rate, we're thinking about terms, lots of different things there. After we've considered any kind of permanent disallowances under transfer pricing, we're then thinking and turning our attention to temporary disallowances, and there's quite a few. So you'll be familiar with some of these. Now, we could have potential restrictions or deferrals. And generally we've got the anti-hybrids legislation, and what that looks to do is where you might have a complex financial instrument as an example, it may be that complex financial instrument is treated as equity in one jurisdiction but a loan instrument in another, and oftentimes what can happen is you might have a mismatch. So you might have a deductible interest cost within a jurisdiction, but the other opposing jurisdiction has non-taxable dividend income. So there can be instances where actually you've got a one-sided beneficial tax treatment, and what the anti-hybrids rule looks to do is restrict that potentially. And then two more things jump to mind. So you've got the corporate interest restriction as well. So where you've got interest costs that exceed £2 million, which is the de minimis, you should be considering your corporate interest restriction. So broadly speaking, your interest costs are limited to a proportion of your taxable EBITDA. So another kind of common mechanism to restrict the amount you can take as deductions. And then finally, you've got the late paid interest rules as well. So potentially where you've got interest amounts that you're paying to related parties and you're not paying those promptly, then they can be deductible on a paid basis. So the takeaway really on all of this is rationalise debt early, complete your waivers in good time. So don't carry out any last minute waivers or capitalizations, as it can often create more problems than they solve. We've got 3 minutes or so left, so we'll just go through skeletons in the closet very, very briefly. A little thought experiment. So just going to pause here for 15 seconds or so, but you wake up, tax due diligence begins today. What issue would you least want a buyer, investor, auditor, or HMRC to find first? And then what we'll do is we'll have a look at some common examples and things that have arisen. So got a list on the left. So we've got late incorrect filings, unreported payroll or benefits, share scheme failures. So quite a lot of things can be lurking. So ensuring that you understand your historical position is very, very important. And then moving on to the current position on next slide, please, Justine. So previous transactions and reorganizations as well, you can potentially have issues. So ensuring that acquisitions, hive-ups, mergers, demergers, all of this good stuff has been executed in line with the documentation as well. So what could you do? So we've identified the risks, and the more positive question now, just to put a spin on it, is what could we potentially do? So ahead of a transaction, the group may need to divest on some non-core assets. You might want to restructure, separate a division, or undertake a formal carve-out as well. The important point here is that legal separation and operational separation, of course, are not the same. So transferring shares or assets may be relatively quick, but separating the people, contracts, IP, systems, all that stuff can take much, much longer. Transitional service arrangements may also be needed as well. So just document those services, ensure they're priced, and appropriate VAT and transfer pricing policy is imposed as well. Management incentives as well also just need to work for the proposed transaction. So like whether options vest, lapse, or need replacing for the continuing management team as well. So overall message, early restructuring preserves options, last minute restructuring normally reduces them. And then we'll finish on some reliefs and value opportunities. So tax readiness is not only about risk, it should identify opportunities to protect and create value as well. So R&D claims, are they fully captured? Also robust enough to withstand scrutiny? Patent box, so has that been considered? Where the group has qualifying intellectual property is certainly very, very beneficial now that we've got the 25% tax rate. Capital allowances, are they being maximised? Do we understand where the losses sit and whether they can actually be used as well? And has overseas tax been suffered that could potentially be credited or reclaimed? the point isn't to claim a relief simply because it exists. It's here to identify genuine relief, support you on your growth journey, and allow you to use them in the right way. Because, as we've seen, an aggressive or poorly documented claim can move very quickly from an asset to another skeleton in the closet. So we'll move over now for some question. So I think the first question, got a question for Justine. As a raise on AIM usually happens by bringing key investors inside and is only announced when confidence in the raise being successful is virtually certain, how will this tie with rules allowing suspension of share trading, i.e. by definition, this brings the announcement of the raise ahead of certainty of success?
Correct. That's exactly right. So, at the moment, you announce it when you know the raise is substantially certain. What this is going to do is reorder events. So you will have to announce first, then you will suspend your trading, then you'll do the wider marketing piece and trying to get some investors interested. So it will hopefully give you greater access maybe to a wider pool of investors. It will make the share price perhaps less volatile and less subject to kind of rumor and speculation. But yeah, it is going to be more risky if that doesn't kind of go ahead in the way that you expect it to. And so yeah, but potentially a bit controversial, I suppose, as much as it could be good news for some people. I hope that answers the question.
Thank you, Justine. So the next one, I think, is for me. So it says, hi, we have one senior employee working overseas, but no local company or office. Could this really create a permanent establishment? So potentially is what I would say. It's very fact specific. What I would want to do is I'd want to understand what that employee actually does. So I can see you mentioned senior, but what does that mean in terms of senior? So what are they actually doing rather than just relying on like a job title, for example? Are they working overseas temporarily, permanently? Does the business have access to the location, for example? So is it his own private residence, for example? Does that employee negotiate or conclude contracts? So there's a lot of different factors that we kind of think of here, but hopefully that kind of answers your question. It needs to be considered with the detail, unfortunately. The next one we've got is what operational inefficiencies are most commonly uncovered during investment readiness and DD exercises?
I can talk a bit to this one. I guess not 100% sure the context of the question, I suppose, but generally speaking, when you're kind of looking at operational due diligence, I suppose, if that's the context of this question, it might be small finance teams, perhaps reliance on key people, which means limited delegation opportunities. There can be poor documentation of processes, lots of reliance potentially on kind of manual processes, spreadsheets, those kinds of things. Depends really on the size of the business, kind of the context of what the due diligence is for. I suppose if you're talking operationally, they're probably the main things I would expect.
Thank you, Justine. And then we've got a question for Laura. So this person said, I thought Scope 3 was a requirement within SECR. Is this not the case?
No. So the SECR is Scope 1, Scope 2, and business travel by road. So business travel is an element, a small element of Scope 3, but then this is even smaller again in that we're only looking at UK and only looking at by road. So any flights or anything else that employees are taking don't need to look at. so yeah, no, not for the purpose of SECR.
Thank you, Laura. And then another one for Justine. So can we early adopt IFRS 18?
Yes, if you want to. I would encourage you to have a think about the timing potentially of your interims, when they're going to happen, where you are in that cycle, and if it makes sense to do it early. The other thing possibly to think about is the point of this is comparability, right? So when are your key competitors, people that you benchmark yourselves against, looking at transitioning theirs over if their year end doesn't align with yours? Might be worth having a think about, because comparability is the point of all this. It's one to watch.
And the other one as well for you, popular, Justine. So what are the key differences between FRS 102 and IFRS post FRED 82?
Yeah, of course. So as much as you'll have the choice potentially under these new rules, there is continued alignment between FRS 102 and IFRS. So after FRED 82 comes in, there are still going to be some differences. Goodwill being amortized under FRS 102, but not under IFRS. Financial instruments are still going to have some fundamental differences between the two. And FRS 102 in general has lighter disclosure requirements. Your accounts and annual report are much likely to be shorter and smaller using FRS 102. They're probably the main differences.
Fantastic. And we got one final question. So it looks to be for me. So it says, we have an EMI scheme that was established before the company joined AIM. How do we check whether the existing options still qualify, and what should we review before a future transaction? So it's quite I think we need to break it down. So we need to look and go back to the date each option was granted, and check that the company, the employees, the option itself met the EMI conditions at that point. That would include things like your eligibility, your working time, say 25 hours, the share terms, your valuation, option documentation, board approvals, and your notifications as well to HMRC. From there, what I would look at is what's happened since grant. So has there been any changes to those kind of things? So working time, group structure, company activities, option terms. Have any reorganizations, acquisitions affected the options, for example? Any subsequent events, have they been reported correctly as well? So there's quite a bit there. Ahead of a transaction, I'd probably also just check what happens on exit, like whether the options vest, lapse, or whether they can be exercised at the right time. And of course, your employment tax, your PAYE, national insurance. The key point really is to do that health check early. So once the transaction is already underway, the scope to repair or restructure can be much more limited, is what I would say. Perfect. Had a lot of engagement there, so thank you all so much for the questions.
Yeah, thank you very much for coming today. If you've got any follow-up questions that you think about after the event, or you'd like to talk to us about any of the things we've discussed today, please do drop us a line and get in touch. We would absolutely love to hear from you. So once again, thank you for your time, and have a good rest of your afternoon.
Thanks all.